Hi, my name is Adam. Welcome to the channel. Thanks for joining us today. Today, we're going to talk about 5 things that you need to make sure you have in your retirement plan, whether it's a financial plan, a retirement, tax, estate, whatever it is. So whether you're doing it, you have a financial planner, you need to make sure that these 5 things are part of it. And if they're not, you need to loop back with whoever put your plan together to make sure that these are now included within the new plan. Before we jump into the content, if you haven't already subscribed to our Investing Academy, we'll put a link below. Again, $20 a month, $19.99. It gives you access to our masterclass. Brandon Beavis and Mark Beavis did a investing course, how to pick stocks and invest and DIY invest and all that. So if you haven't checked it out, again, link below. And as well, if you're looking for fee-for-service financial planning, if you're kind of stuck, not sure what retirement looks like, not sure what to do first, second, third, again, we'll put a link below, but parallelwealth.com/planning is our financial planning services. You can learn more about that and see if it's a good fit for you. So when looking at your retirement plan, the first thing you want to look at is a real dollar income. There's a difference, real dollar and nominal dollar, okay? So real dollar is what the value of the dollar is today. So you can see this is our financial planning software, and you can see here we have a real dollar number. So for this client, it's about $70,000 a year. This stays the same. You can see that dollar amount stays the same in this example. The nominal dollar beside it is the actual dollar amount you'll have in that year adjusted to inflation. So in this case, we have it adjusted at 2% inflation. So when this client is 75, they're going to have $84,796 in their pocket to spend, which is equivalent to $69,562 in today's dollars. So you want to make sure, A, there's inflation protection within your plan, that your buying power stays the same. And it's nice to see that number, right? Like if we just showed you the nominal dollar, it's like, well, what is that worth today? So having that real dollar number, you can kind of see, okay, I know what my buying power is today. I know the inflation rate I used. I know that 5, 10, 15, 20 years down the road, what my buying power is versus today. I know what things cost today. I can keep up with that. So real dollar number is very important to have. The second thing you want to talk about within that real dollar number, I'll highlight here. So annual after-tax dollars required to cover lifestyle expenses, not including taxes paid, debt payments, and asset contributions. So when I go through a financial plan with a client and kind of explain this process to them, I say, look, this is the amount you're going to have in your pocket to spend after you've paid your taxes, put any money into savings. So if you're topping up your TFS every year, that's already done. And if you have a mortgage or other debt, that's been paid. So what you see here, the $69,562, that's spending money. That's to live off, to pay your everyday bills, to travel, all that kind of stuff. Why I like to look at it this way is, let's say you enter retirement, or maybe you're a few years from retirement building a plan, and you have a mortgage. When we show you this $70,000, when your mortgage goes away, that $70,000 stays the same. It's the same cash flow into your pocket. If you look at a real dollar number that has to include your mortgage, then there's going to be a big adjustment for when your mortgage goes away. Once your mortgage is paid off, this number stays the same. We're just going to draw less out of your accounts. So I think that's more valuable. And after doing this for 17 years and delivering hundreds of these plans, this makes the most sense. And that's the feedback we get from clients too. So try and have your plan that way. The second item that your plan absolutely needs is the breakdown and timing of when to take government benefits. And we can debate this all day long. I love reading the comments on my, when I say take CPP at 70, I love the comments for you guys saying, no, take it at 60 because you don't know how long you're going to live. Absolutely true. I can't argue that, but you have to use statistics, right? So we could argue all day on what the best time is from an emotional side of things. But I think it's important to run the numbers at 60, 65, and 70, when to take your CPP, and at 65 to 70 on OAS. And there might be times in between, right? So if you're on 65 and 70, 70 is the best, and you try 69, 68, run these different ages, but get a general idea on when you should be taking your CPP and OAS. Don't take 60 because it sounds good or your neighbor did it. It may be costing you tens of thousands of dollars. Now, there may be a reason you do it, a health reason, whatever it is, but typically we will defer CPP till 70, if it makes sense, obviously, from a dollar perspective, which it does for most. The OAS, we will often tell people to take it at 65. Bumping OAS till 70 makes a smaller impact. And a lot of people retire early, 55, 60 years old. If they wait all the way till 70, or we tell them to wait till 70 to take government benefits, what we found over the years is that clients don't want to wait that long to get money back from the government, and they end up starting both CPP and OAS too early. So typically we'll say, look, start OAS at 65, scratch that itch, but defer CPP. Again, every situation's a bit different, but what you need to have in your plan is when does it make sense to take CPP and OAS? And what are the number differences between taking it a bit earlier or a bit later? The third item you need in your financial plan, and I preach this on the channel all the time, and I know this is the biggest impact to your tax bill in retirement, is an RRSP meltdown. The simplest way to explain an RRSP meltdown is how do you draw down or get rid of your registered account, whether it's a RIF or a LIF or whatever it is. How do you get rid of those registered accounts that are going to be a tax bill if you die as soon as you can, but as tax efficiently as you can? And typically we'll try to melt down those registered accounts by between 85 and 87, which is roughly life expectancy. In this example, if I look at Mr. YouTube here, you can see his RRSP. We're drawing down about 30,000 a year. So 30,000, it drops to 20 here, and it dropped to 20 here because that's when his CPP was starting in this example. And it goes to 20, goes all the way down. And if I hover over here, we'll see that this one, he was done his RRSP. So it's melted down by age 84. And the whole idea there is, look, if you pass away when you're supposed to, like mid to late 80s, then you're not going to have any registered accounts left, which means that it's a more tax efficient plan for your estate. Now, obviously you have to kind of massage that with the tax bill while you're alive as well. And that's why when we build a plan, we look at what is your taxes, total taxes from now to death and death taxes, like the combined total tax that you're going to pay CRA, as well as your income. If we can boost up your income and reduce your total tax bill while living and dead, or maybe one or the other, depending on what you're looking to do for your estate, that's the goal there. So again, you need to have a plan to melt down that RSP or any other registered accounts within your retirement plan. The fourth item you need to make sure you have included in your plan is looking and leveling out your average tax rate. So your average or effective tax rate. Now, leading up to retirement, like while you're working, even now for myself, I'm working, I have an income coming in. I don't really focus on my average or effective tax rate. I focus on my marginal tax rate. What is my marginal tax rate? Which is the tax you're going to pay on the next dollar that you earn. And why I focus on that is so if I put money into an RSP, I know roughly how much money I'm going to get back. So as you build up to retirement, definitely the focus has to be and should be your marginal tax rate, not your average tax rate. But when you hit retirement, definitely look at marginal tax rate. It matters. Don't get me wrong. I had someone in a previous video say, Adam, you have to look at marginal. Of course you have to look at marginal tax rate, but you need to actually spend more time on your average tax rate than your marginal tax rate. Leveling out your average tax rate through retirement is going to save you money. And I can tell you that wholeheartedly because we've done it hundreds of times for hundreds of people in hundreds of different situations. There's not a single time where we try and level out that average tax rate that it doesn't put more money and income in the client's pocket and save them taxes both now and at death. In our software on the very right-hand side here, you'll see our tax rates. We show both marginal and effective or average tax rate. Now you can see this client, we try and keep it within 2 to 3%. You can see we've kept it in that range right through. And as we go down, it continues to do that. So that's a key part of your retirement plan. When someone phones me and says, hey Adam, I'm thinking about getting a financial plan. I've been retired for a year or two and it's been great. I haven't paid tax for the last 2 years. I mean, we all like to think pay no tax is great, but all you're doing is pushing a bigger tax bill later. The more your average tax rate goes like this as a roller coaster in retirement, the least beneficial your plan is for you and the more beneficial it is for CRA. If you're married or common law and you have a partner to kind of income split with, try and not only level out your tax bill on your side, but try and get your tax rate, average tax rate, and your partner's roughly the same as well. Then you know your income splitting is working well. So those are the two things you want to look at there. The fifth and final thing you need to have in your financial plan is a lever account. Now, what do I mean when I say lever account? A lever account is an account, if you need a bit more money, that's where you pull from. And if you don't, that's where you put it back into. So if the world shuts down again and you can't travel and you plan to spend 80,000 a year, now you're only spending 60, or you plan to spend 50, now you're only spending 30, whatever the numbers are, you have extra money. Your lever account is, okay, we're going to just either leave more money in that account or actually put more money. So typically for most people, it's a tax-free savings account. If you have a non-registered account and a tax-free account, then it's your non-registered account. Once you've got rid of your non-registered account, your lever account transfers over to your tax-free savings account. You want to get rid of those non-registered accounts typically a lot sooner than your TFSAs. So if you need a little bit extra money, that's where you pull it from. If you don't, that's where you leave it into or even top up. When we look at this client that we have in the system here, you can see the TFSA account has random and small, fairly small withdrawals. So random withdrawals. So if the client needs all the income that we've shown in the plan, then the first year they're going to take a small amount, $17.79 out of the TFSA. The next year, $21.88. If we go over to Mrs. YouTube, it's going to be roughly the same. They're going to pull a bit of money out, put a bit of money in. If I go to their combined view, again, we're looking at roughly a $70,000 combined income for them. So let's say in a year that they only needed $60,000. So they had an extra $10,000 of income that they didn't need. Not only would they not pull out of their lever account, their TFSA, but now they're actually putting money back into their TFSA. The RRSP meltdown still happens. You still want to do that. That's your tax plan. You want to follow that tax plan. Your lever account is when you need a bit more or need a bit less. So make sure within your plan, you A, have a lever account, and B, you know what that lever account is so that if you need a bit more money, you know where to pull it from. And if you don't need the money, you know where to put it. That's a huge and important factor within your retirement plan. So thanks so much for joining us in this video. Hopefully it helped. Again, review your financial plan, your retirement plan. If you don't have one, again, we'll put a link below, but parallelwealth.com/planning. We do offer fee-for-service financial plan. But if you have a plan, maybe you put it together yourself, maybe you have an advisor at a bank or other financial institution, review these 5 things within your plan. And if something's missing, 1, 2, 3, 5 of these things are missing, loop back with your financial planner and have them put it together for you. Again, you need to have these 5 things. I can tell you they are hugely, hugely important within your retirement plan to make sure that it's optimized. So thanks again for joining us in this video. We'll see you in the next one.